and welcome to the latest installment of the Avid Commentator Report. Today we're going to be looking at some comments and a presentation made by St. Louis Fed President Bullard, who is, well, he's known for rocking the boat and for his rather hawkish commentary. He is arguably the most hawkish person on the Fed committee, and he had quite a lot to say about inflation and where he thinks rates should be going. As you can see from the graph on your screen, he suggests by using a metric called the Taylor rule, which I'll put a link in the description if you want to explore that in greater detail, that the federal funds rate should be between about 5 and 7% in order to be what he deems sufficiently restrictive on spending and on the broader economy in order to bring inflation down. Now, this could be several things. It could just be Bullard being Bullard and doing his usual thing of just being hawkish, because that's basically who he is, and that's what he's shown over his more than 30 years of working at the Fed. Or more likely, in my view, I think that there is also another factor at work. In recent weeks, we have seen financial conditions, as the Fed and as Goldman and as a number of different people measure them, loosen significantly. And this is the opposite of what they want to see. They want to see financial conditions tighten. They want to see them above neutral and reach a point where they are then putting downward pressure on inflation. But that's not what's happening. It's completely reversed course over the last few weeks. Now, if you look at the St. Louis Fed's financial conditions index, we are seeing them down towards the same levels that they were in June. Now, that really speaks volumes about how much damage this is doing in the eyes of the Fed in terms of their attempts to rein in inflation, because as far as they're concerned, going by their metrics, we are now roughly at the same point in terms of tightness of financial conditions as they were at the start of June, when the federal funds rate was 1%. And that is the complete opposite of what they want to see. And we still, during this cycle, have not seen the financial conditions index of the Fed above what they would consider neutral. And it's been a similar story looking at the Goldman Sachs financial conditions index. That, as you can see on your screen, has had one of its most loosened weeks ever. And that is the complete opposite of what the Fed want. So I think that this is a really key point by Bullard, that we may require higher rates. That's entirely possible. I think that's a scenario that's well worth exploring, because so much now is currently based on base case scenarios. It's not based on something else going wrong in the world, some other geopolitical event, some other economic event, some other supply chain event that we can't foresee. Well, that we don't yet foresee as a potential problem. So I think that it's a scenario well worth exploring, but I think it's also just worth noting why Bullard may be doing this, and the fact that he's probably not the last person from the Fed to come out with this type of commentary. Another Fed president came out last night, and I'll whack the quote up on the screen, but they basically said that a recession is much more preferable to the damage that in letting inflation run riot will do. And I think that's the clearest message that we've got so far, that the Fed's number one priority is inflation, that even issues of systemic risk and stuff like that are now taking a bit of a back seat, because there are targeted measures that the Fed could take in order to address that. I'd be very curious to know exactly how you think all this is going to play out, whether you think that we are going to see a federal funds rate well above 5%, up towards 7%, or maybe even how this will impact other countries, how this will impact Canada, Australia, New Zealand, the UK, and all around the world with a much higher rate than pretty much anyone was anticipating. Also, just a little note, I recently did a live talk for Pepperstone Talks in Melbourne, and if you would like to watch that particular video, it goes for about 25 minutes, there will be a link in the description. And just the usual, like, comment, and subscribe, and thanks for watching.